welcome. You're watching Money 9. I'm Sakshi Batra, and on this show, we are going to be discussing all about markets and how are market experts really looking at the current scenario in the stock markets. Are we going to soon see a breakout of the consolidating range that we've been seeing in the markets? And where should you be really putting in your money to make maximum amount of profits? To help us understand much more about markets, I have with me a very special guest joining in. With me, I have Mr. Ajay Bagga, who's a market veteran, has been investing in the markets for decades, and we are here to seek all the kind of insights that he has to share from his wisdom of experience of the markets and trading and investing in both Indian equities and in global markets too. Welcome, Mr. Bagga, and thank you very much for taking out time for Money 9, and thank you for joining us on this edition of Market Masterclass. So, welcome, Mr. Bagga, and thank you for joining in. Let me just kickstart this discussion by asking you, why are the markets really not giving us any clear signs of where they're going to go from here on? I mean, about a month or two back, there was all the discussion around the rising inflation and the fear about that. Currently, there is again the fear about growth happening, the delayed economic recovery, and the markets are not ready to make up their mind. So why is that happening, and how do you see the markets going from here?
Yeah, it is not an easy environment. The positives, of course, are the liquidity, the stimulus, which is still on the accommodative policies globally. But there is a storm of negatives brewing up. First being inflation, second being compressing margins because of the commodity and input costs going up. The third being that we are near to very high valuations, and that normally leads to what you mentioned, consolidation or sideways market till the earnings do a catch up. So we are not a cheap market globally. India also, we are maintaining our normal premium to emerging markets. So it's not a very cheap market. It kind of flared up in February. For us, we have not reached those lifetime highs so far. Probably the December end targets for most supply side brokerages were met in February itself. So now I think instead of the market really reaching new highs, unlike the US, it will be a very stock specific market, sector specific market. You will have to really actively choose your sources of alpha rather than just a beta play and where the entire market carries the returns. I think it will be a more choosy market going ahead.
Absolutely, and you've rightly pointed out, I wanted to discuss this as well, that for new investors entering the market at the current juncture, they have already missed the kind of sharp run-up and the one-side move that we've seen of the markets in the last 1.5 years. So should they now moderate the expectations? What are you looking at in the second half of 2021? And how exactly should an average investor really approach? Is that going to be extremely stock specific now?
Yeah, absolutely. So, as far as your expectations go, even if the market gives you returns like it did from last March to this March, or to from last March to February, it gave a nearly 100% return. Those are like 5-6 years of returns that you got in 1 year. And the averages always catch up. The good thing is our markets were underperforming for a number of years. Before 2020, our markets had been underperforming. So we have a lot of catch-up to do vis-a-vis the world. Economically also, we have been seeing that we were slowing down. We were not really galloping based on a lot of policy steps that had been taken. We were set for a good run in 2020 when the COVID came in. And it has led to a postponement of that growth. That growth will come over the next 5 to 10 years. If you're getting into equities, have a very long perspective, a long-term perspective, especially at these kind of valuations. These are not the valuations to try to enter for a quick buck. There you will get burnt.
Absolutely. And how much attention are you giving to the relentless selling that FPIs have been doing? Are there any red flags that you may want to put out for us on the table that all the new investors should be aware of?
See what happened. I'll give you an example. Yesterday, it came out. Uber in the US fell 5%. It came out. SoftBank sold one third of its stake, nearly 45 million shares, to make up its losses in China on the DD Global shares, which went from $14 to $7. So that's what also hits India from time to time, where foreign investors who are investing in India as a global emerging market play within their portfolios, when they see cuts elsewhere, say if Thailand, the way the currency is going down, the numbers are going up, Malaysia, the way the numbers are going up, if those markets underperform and they have to make up the return of the fund, you will see profits being booked in India. So we saw Reliance, HDFC Twins, Infosys, Kotak, ICICI being sold in India. These are diamonds which you never sell. So clearly it was a question of covering up China losses, covering up emerging market losses. For nearly 16,000 crores have gone out in July already from our markets, and it's been a multi-month trend. The huge inflows that we saw in October peaked out in February, along with the peak of the markets, and since then we have been seeing a slow outflow. Not very big yet, but we are very much connected to the global markets. So the short answer is keep watching the global markets. Our markets will take direction from there. We won't be spared. If there is a huge correction elsewhere, even more money will be coming out. I remember in 2008 an FIA had told me that, when we came in, we saw your market was as liquid as Taiwan. And when we are trying to go out, it's not even liquidity of Thailand that we are finding. So now we are much bigger. In these 13 years, we have built a lot of stability, a lot of depth in our markets. But still, if you are stuck in Thailand, Malaysia, Philippines, you will go to the more liquid markets and liquidate your profitable positions, knowing that you can come back there when you have liquidity issues within the fund or return issues. I think that's what's happening to us as well.
Okay, but there's one common factor that global markets and all of us in India also have been watching. IPOs have been the clear big buzzword. I wanted to ask you first, starting with Zomato. Are you a shareholder of Zomato yet? And if not, then what is holding you back?
Yeah, no, I'll just take a few shares just to keep that it comes on my analysis horizon. But I have been seeing the global listings of these food delivery apps. It is private equity guys have played a very good hand. They kept ramping up, and the same private equity guys like Anderson, Horowitz, and all would write that this is different from .com, because .com we used to take companies public earlier and at lower valuations. Now we don't want to part with these. So they have been passing the ball between themselves. A company which got in January on a few $100 million inflow, you value it at 4 billion. Then you come in at IPO at 6-7 billion, and then you take it to 15 billion post the IPO with no paper available. So the private equity guys are the ones laughing all the way. This is profitless prosperity. There is no view of profits anywhere on the horizon. It is just an app with no assets, a lot of intellectual rigor in it. Definitely a good managerial practice. But you want good management, you go to Hindustan Levers, which is the CEO factory for the world. So highly overvalued, very difficult to say where it will end. Probably there will be a few Amazons, few Alphabets, few Apples which will come out of all this fraud. But 90% of this fraud will leave investors with huge losses. The private equity guys have been very smart on small portions of circular trading between themselves. They have bid up the prices, and now they have set a highway on which you will have 4 or 5 more players coming in. And I was shocked when I read that SEBI is even considering allowing SPACs in India, We are
Yes.
still a very emerging market, full of operators, full of people rigging the markets. And to allow things like SPACs to come in, then we are, at the cutting edge of the Wild West capitalism. And it will end very badly like 1992. So I hope the wiser councils prevail and SPACs are not allowed. Otherwise, it's blank checks that you are writing. And in the end, it is the state money, like you saw in all the NBFC scams. EPFO money stuck there, army wives' pension money was stuck there, temple monies were stuck there. It will come back to those people whose necks will be slit.
And you know what happens to the retail investors who are actually making a beeline to get outside and take some kind of a pie out of all of these companies? Because of course, the kind of concerns you brought out, they are loss-making companies with no profits inside. There are no commentaries or any kind of roadmap of improving any kind of financials there. So all of us are actually just grabbing onto something which is the new age, a new entrant and a new segment that is getting created. So there are these two parallels. One, if you see the success of Zomato, it makes you wonder, as a traditional investor, you've always been looking at cash flows of dividend yields. And when you stick to that old form, then you miss out on something which is exciting. And you rightly pointed out that, of course, we have seen FANG stocks. Of course, questions were made there also on Amazon, on Facebook, Netflix. But two of these three are now $1 trillion company. Anything like that happening in India with these new age companies that you see?
Yeah, some of them will come up. The India consumption story will come through. But we'll have to see. Without any basis. If you look at Amazon, he kept on investing into the business year after year after year. You look at, say, a Tesla. I don't know, at least he's making $10 billion of revenues. And, with the solar play, the renewable play, all those things, there will be catch-ups. So already from $900, 600 seems to be where the market has found value. In manufacturing play, these are platform plays. You add on the consumer theme to it. So we have seen a lot of these. In 2008, it was the infra play where investors were taken in helicopters over Mumbai and shown the SEZs, and those funds never gave returns to our clients ever. And same people have got activated again, who are rolling out these stories. It happens every time in market cycles, and normally it points to the end of the cycle. I hope it's not. Very few people are really afraid right now. Everybody's in the euphoria. And look at China, for example. China let out the steam by 3-4 actions. Moment that Friday note came in, the edtech stocks, everything, and then they said the food tech has to treat the delivery boys better. And Meituan tanked 15% one day, 14% another day. So what is the valuation? If your valuation can go off 30% with one regulatory, comment in a Communist Party paper, then what is the valuation you are really running? See, Facebook had advertisement, Google had advertisement, Apple had hardware, Tesla has an automobile and solar play. What do you have? Anyone can start this. Yes, you have shut the door by getting it into huge size, and it's a duopoly now between two players. And it's not sour grapes for me. I've seen the play. We have sold these private equity funds all over the world. I've been part of due diligences on them. I know exactly how it works. This is the play by the smartest money in the world, which is extracting value out of the foolish retail money. That in short, and the regulators are in 18th century if these guys are in 21st century, and the customer probably is in 19th century or in La La Land, not even on Earth, but in space, and dreaming of how they will make the money which these promoters or investors have made. That doesn't happen in life.
But do you think this change in policy in China, like you just talked about the edtech space, is that going to have some kind of a positive impact on Indian companies, Indian tech space?
I think you should look at it in two ways. What are the Chinese trying to do apart from the power grab by the Communist Party, which was already there. They have a party chick sitting in every company and forming those study circles and everything. And most of these CEOs are part of the Central Politburo or the policy making committees. So it's nothing new. Why did they come out of behind the curtain? So there must be some angst at the public level, and that comes back to the inequality, especially what has happened in 2020 with the COVID. Asset owners have done very well. I have sat at home and worked off my laptop, but the hawker on the ground, he's lost everything. The auto driver, the taxi driver, same thing has happened in China. So they are trying to create this image of the Communist Party being pro-poor and hitting out at the billionaires. That's one. Second, on the edtech model, a lot of this is fluff. A lot of it is creating a FOMO in the tiger moms that at any cost you have to get your child on this online portal, and then your child will be a wizard. Otherwise, he or she will be left behind. So a lot of this FOMO has gone into these valuations. Otherwise, why aren't your schools, your colleges, universities? I studied in Delhi University. Our annual fees was 300 rupees. And excellent, what I learned there, half of IAS, half of IFS is sitting out of Hindu College, where I studied. Most of my friends are at joint secretary level now. Those were very good institutions. They never went. They were not for profit. So what China said, EdTech, I want to move it into not for profit. The foreigners should not control it. And that anger that a SoftBank or a US investor, a Tiger Global is making all the money while the Chinese consumer is paying for this. I think that will come into India sooner or later. It will become a political issue once it becomes big. So the sustainability and the pricing of it is the issue. We show that there are these hundreds of millions of children in India who need education. There is very little penetration. I think of my driver and my housemate, their children who are struggling to study on a small phone and manage. It's not a model for India. It's for the elite of India, the anglicized elite, not for the masses as such. The coaching factories which are getting billion-dollar valuations, that's all in the FOMO. It will change in a generation, but political change could change it much faster. That's the risk, I would say.
Understood that. So now moving back to the secondary markets from this entire IPO space, the new entrants, and I wanted to ask you what you also pointed out in your initial comments as to why the top rung companies are actually losing value at this current point of time. We have been seeing a Reliance Industries that has been underperforming. The HDFC twins have been laggards as well. How are you seeing this kind of an underperformance? And what really happens to the traditional sectors right now? How should investors really approach that? FMCG, banks, pharma, steel, oil and gas. How do you approach them?
And Sakshi, that's a brilliant question. And this is what I have been, 31 years. I've been in financial services. I've been a banker. And I was a very cutting-edge banker in Citibank in our consumer days, where they really invented the consumption story, the consumer banking story, and HDFC, ICICI took off from there, mostly run by ex-Citi bankers. So I'm also thinking if a Kakao bank in Korea can get $36 billion valuation, why hasn't HDFC launched 10 apps? It is so difficult. Now, the government has changed all FCRA accounts. You are forced into SBI Parliament Street branch. All NGOs in the country, 40,000 accounts have gone there. It takes 1 week to identify money which came. And if you have a Revolut account, I have PayPal, Stripe, it comes within 1 hour you are seeing. Even your Western Union is faster than SBI. Why is SBI not waking up? And if that Yono app is really so good, why can't it become the Kakao Bank of India? Why aren't HDFC, ICICI and SBI shutting out the door on these fintech platforms? So it's because you are a dinosaur, you have scale, you're too afraid of losing it. You have set up these white elephant branches, you don't want to lose. In 96 when we did Suvidha in Citibank, and my target was 150,000 accounts in 3 years. We did it in 1 year, and we were profitable by the end of the first year. That shows electronic banking. We did the first debit card in India, the first web banking in India. Now it is so simple with the smartphones and the whole country wired up, 700 million people available to consume over the net. I'm just wondering why these old companies are not doing it. They will get their act together. If I am thinking of it, you think the CEO of HDFC or HUL or ITC is not thinking? They will think about it. Walmart has started its own Amazon, buying out Flipkart, and now creating a Walmart, Amazon. It will happen, and that's what will squeeze out these tech players. But right now, edutech, health tech, fintech, all doing very well. The old companies, when I was in Deutsche, for example, there were 27, 28 legacy IT systems. The corporate bank would not talk to the consumer bank. We had to build a system to pass the entries. So when you are such a giant with trillions of dollars of assets, you can't turn immediately. But I think the best thing would be start subsidiaries to take on these fintechs and occupy that space. Aditya Puri had spoken about it 3-4 years back, but nothing got done about it. The technology for basic banks today is really pathetic, and the customer is losing out. Those margins are what the fintechs are aiming at, and they will clear out. Look at Revolut, what they have done. They don't even have a banking license in the UK, and they have 100 billion sterling of deposits. That will come, but I would say SBI should be spawning the Paytms. SBI should be spawning the policy bazaars. Rather than leaving this field for foreign-owned capital to come and take most of the money out of the Indian investors' pockets.
I hope all the CEOs are actually listening to you and to absolutely take this on a war footing so that they do not lose more ground over here, which they can actually make into a profitable venture going forward, and take all of this market also under them. But let's also ask you, like in the end, before I let you go, for new investors entering the market right now, help them understand where are you putting your money to work in the current market scenario. If the large caps are losing money, you've given a handful of a salt that they need to take before they go ahead and invest in these kind of new IPOs and entrants. But where do they invest then?
See, invest in your education. That is first, because the more aware person will make more money. Start reading annual reports. If you read one annual report, you're better than 98% investors in this world. They have never read an annual report. Pick up Reliance annual report. Try to learn, try to read it, assimilate it. You would know everything about retail, about telecom, about e-commerce, and about standard O2C. So the oil business fully. Start with that. So invest in that. Second, this is not the market to come in whole hog. Use the SIP route. That's what Indians are doing now. It's gone to 9,300 crores a month. They are the ones who made the maximum money last year. The HNIs stood aside and were too afraid to re-enter. They lost most of the uptrend. It's the SIP investor. So go the SIP route. Third, any single exposure, don't let it be more than 2% of your portfolio. Even if you like Zomato, you say, I order it every day. It doesn't mean that Zomato is 15% of your portfolio. You want to have a play, put 1% in it. I'll give you one statistics to end this talk. They did a study at a university in the US from 1926 to 2019. The numbers are updated till then. 650,000 companies across markets were studied. Only 4% of the companies were responsible for the 100% of the market returns. Only 4%. Now, if you ask me which are those 4% for your lifetime, I'll be totally off. When I started working in the late 80s, it was a different India. Every 10 years, the leader changes. I remember one presentation I used to make of, Microsoft not having gone anywhere from 91 to 2003. And I would compare that to Dhirubhai Ambani's track record and show. And just after that, Microsoft took off and Reliance went underground for 4, 5, 7 years. There was very little shareholder return. And then once Reliance what it did last year, the way Reliance took off. Yeah. So you don't know when it will take off. I'll give you one tip also, which is the number one stock mutual funds went into last month in June. Biggest exposure taken. One guess, ITC. Because all the memes, all the jokes, everything is now on ITC. Anywhere anybody wants to show a slumbering, procrastinating, failure, loser, they're showing us ITC. All the smart money has gone into ITC last month. So when everybody is convinced on one side, the market is designed to give a big shock. So not more than 1% to 2% of your portfolio in a single stock. Keep that as a mantra. Stay very diversified, very long term. Try to avoid the fashions and the momentums. Don't be pessimistic. We have to be optimistic to make money. So you have to take the chance and get in. Only 4% of India is really invested in the stock markets, and they are making all the money. 25% of our markets money is going abroad. So change that, invest in your country, and make the money is what I would say.
Absolutely wonderful. Thank you so much for these wonderful insights and these words of wisdom. I'm sure all the investors, viewers who are looking at you and watching you should have taken all of this and noted this down as in how you've spoken to us, and hope to have you back with us again for more such interesting conversations and insights on the markets and how should we approach it. Thank you so much. It's been a pleasure, as is always, sir, to have you with us.
Thank you.
And with that, we wrap up this edition of Market Masterclass. Stay tuned on to Money 9 because a whole lot of action is going to be unfolded right after as well. And for more such conversations, you need to like and subscribe to our YouTube channel. Hit that bell icon so that you can get notified whenever we add a new video. And also stay connected with us through all our social media platforms and visit our website money9.com for much more on markets and on personal finance. Thanks for tuning in.